In this week's update, how to negotiate markets that are intolerant to anything slightly amiss. AI and semiconductor trade is still unwinding. And what's next in AI, gold, and the beneficiaries of the rotation? My name's Gary Davis. I'm an authorised representative of Primary Securities, and the information in this video is of a general nature only. The last few weeks, I've been focusing on hyperscalers, and that's absolutely necessary because so much hinges off that. There's a lot of structural change in AI that's unfolding. It's moving very, very fast. What is proven is that the AI demand and the cloud level monetisation of that demand is increasingly proven. So I think we've gone beyond the point where that's in doubt, but the market has really been forward-looking and has been looking beyond that for some time. The acceptable returns on CapEx and the sustainability of what the hyperscalers are now doing with moving from self-funding to now debt-supported CapEx is still not. So that's still the open question. We don't have an answer to that yet, and I'll be talking quite a bit more about that during this video. So we've got a sector that's in rapid transition, and therefore anyone that claims they know where it's going is having a good old guess, because it really is moving very, very quickly. But there is increasingly credible evidence on the returns. So at least part of this AI trade is probably going to deliver investors some good outcomes. And that's from AI through cloud consumption, through improvements in advertising, subscriptions, and enterprise products. So there's lots and lots of green shoots happening. It's not a matter of hyperscalers just building in anticipation of future demand. They've got their collective fingers and arms crossed, and they're hoping it just all works out. When you stand back and think about it, they're probably way too smart for that. They didn't get to be as big as they are and as dominant as they are by just blindly investing in hoped-for future demand. So I think that one is pretty much off the table. But there are some other things. But before I get to that, let's just go and look at a couple of charts just to demonstrate a bit more about what the output from the hyperscalers has been. So this is Microsoft. They reported halfway through the week, and what was evident from their report is that the available compute is being absorbed almost as quickly as it's installed. So it's insatiable demand. Cloud growth is accelerating. The demand base is broadening beyond a handful of just the frontier model developers. The growth of Azure was 43%, and the demand is continuing to outstrip capacity. And then on top of that, the newly commissioned capacity was rapidly monetized. So they've got a commercial backlog of about $678 billion, not about, exactly, according to their report. And the latest sequential growth from customers, and this is really the important part, it's not necessarily what Microsoft and Amazon and Google are doing and the impact on their business, it's the impact down the food chain. And the latest sequential growth from customers outside those frontier model companies is coming through. Now, Microsoft had $19.6 billion of quarterly cash flow, but they spent $41 billion on CapEx, so negative free cash flow. And they're increasingly being pushed into data center finance and operating leases. So the game is changing. This is no longer a self-funding model. If we look at Amazon Web Services grew 37%, which was the fastest rate in 18 quarters, and their operating profit was up 64% to nearly $17 billion. Google Cloud, the week before, grew 82%, tripled their operating profit, and their margin was up to 35.6%, which is a really healthy margin, and the backlog was at $500 billion. Now, for those that aren't really into all these numbers, apologies, but there are many people out there who do want to see that we've done our research and we're not just plugging into the narrative. So it's a little bit of that as well. But there is increasingly credible evidence that the hyperscalers are earning returns from AI through all of those areas that I mentioned before, and they're just not simply accumulating for a hope situation. Far from it. If we look at NVIDIA, so it's starting to go down the line a little bit now. The data center revenue was up 92% at the last time they reported. Broadcom AI chip revenue was up 143%, confirms the build-out remains very strong, but it is broadening. But that still only proves that hyperscaler expenditure, not the ultimate productivity that should flow from that to corporate AI users, is actually being achieved. So that's still an open question. So the principal risk is not the near-term access to capital, because the hyperscalers still, whilst they're now into negative free cash flow, they're still producing enormous operating cash flows. So that's real. But the investment, that this is the risk, that the investment continues to rise quicker than the monetisation of that capex. And leaving aside the higher debt, the lease commitments, the depreciation and energy costs, if utilisation or pricing weakened, that's where this whole thing could start to fray at the edges. But at least the core of it is there and unquestionable. We'll come back to the rest of the American market in just a couple of slides. So what's changing? Well, there's a huge amount changing. The direction of the US dollar, it's a brave person that would say it's going one way or the other. Logically, based on all the fundamentals, it should be down. The US debt, the ballooning interest payments, etc., etc., etc. I won't go through them. The list is long. But up until the last week, it was actually heading pretty definitely in the other direction. And then we've got the big one, which I think doesn't get the press that it should get. That's because most people don't really understand the bond market and how it interplays in all this. But the bond yields versus the Fed. So the Fed held rates steady, yet bond yields continue to rise. So that's a situation that is not sustainable, and it has to resolve itself. And there's an old saying that I'm sure everyone's heard, that you don't bet against the Fed. But the problem we've got at the moment is I don't think anyone really knows what fight it is the Fed are in. Are they fighting inflation or seeking to hold up the economy? Because they're kind of between a rock and a hard place, no matter which way they step on this. So I think there is considerable policy risk involved here that the market is not really acknowledging, judging by the way that the prices are moving. And it's probably going to take a few more Fed meetings until we get a sense of what is it that they're fighting? What are they giving priority to? Because if they fight inflation, they'll tank the economy if they do it properly. Or if they're looking to hold the economy up, then inflation is just going to get out of control. So it's a very, very tough situation. Gold and silver, as we'll see on the chart in a minute, is really at a key inflection point. And again, logically, you would expect that resolution to be to the upside. It would be unfathomable almost on a logistical, on a logical basis for the price of gold to break down. However, it's possible. And sentiment of the market has definitely moved more defensive. There's no question about that. And some of the beneficiaries into healthcare, industrial, finance. But look, there's sector themes. And what is far more important is stock selection, because there is an incredible diversity of opinion and price moves out there. And we've seen that through the earnings season with just these amazing divergence in price responses in the market. Quite extraordinary. And of course, as we point out every week, this market is offering fantastic opportunities. But there is also a lot of risk. And the risk is not with the stock per se. The risk is with the investor and them knowing what they're doing and what their plan and process is. That's the risk. Stock selection is vital, but that's not the biggest risk. The biggest risk lies with the investor. That's why just getting clear on what you're doing is so critically important. Let's look at American stocks now. The S&P was up by 1%, the Nasdaq by 1.5%, and the Russell was flat. But it was a very wild week. 1.6% does not reflect the week that the Nasdaq had, which fluctuated over a 10.5% range. Just think about the money involved in the Nasdaq, and to be fluctuating over a 10.5% range is extraordinary. Semiconductors had a 13% range, and some of the daily moves by some of those semiconductor components were also extreme. We'll look at that in a minute. And what was the narrative around all this? What was the prevailing opinion? It's just totally incoherent, because there are people who are bullish to the extreme and people who are bearish to the extreme, and the market responses reflect that. And it's also being driven by headlines on a day-to-day basis. A company comes out with a headline, or one of the major investment banks comes out with a headline, and the market just reverses course. It's just incredible what's going on. The US dollar index fell heavily. We were at 101 and change. Earlier in the week, we finished under 100. And that came down because of the Fed decision on rates. But the bond market said something totally different, and the 10-year yield went from 4.47 to 4.74 in the month of July. So it's been an extraordinary move for the bond market in just the space of 1 month. So this whole rates on hold but yields up is just so terribly important. And the mainstream investors really don't pay any attention to it because they don't understand the ramifications of it, but the ramifications are huge. And what's that choking noise that you can hear? I think it's the Fed. The Fed, between a rock and a hard place, they are really, really getting squeezed, and it's very difficult to see how they're going to be able to engineer a nice calm landing on the lake out of this. I don't think it's possible, and that will certainly influence the market volatility. Just stepping back and thinking about the ballooning US debt, and interest rates are going up in the bond market. So that means that the cost of the US government, interest expense for the US government, is rising irrespective of what they do with the cash rate. And the VIX finished at 16, which I expected to see something in the 20s when I flicked on Saturday morning, but it was at 16. So that just tells me, and hopefully I'm making the correct assumption here, is that money is not leaving the market. The big players are not grabbing for insurance. This is rotation. The money is shifting from one area to the next. Let's go and look at some charts. We'll start with the Nasdaq. So, of course, the biggest issue here that's been creating all this obscene volatility, to a degree they're transient impacts on the market, but on another hand, there are also some real structural issues here about how the global financial system is actually positioned. So we had some incredibly crowded positioning that it was built on leverage, and that you just need to step back and think about that. That is completely unsustainable. People with high leverage, high margin debt, and they're all crowding into the one position. I mean, what could possibly go wrong? There was the Korean memory stock leverage unwind. Millions of inexperienced traders punting their hearts out. Then we had a major hedge fund called Situation Awareness, I think run by some very, very young person, and taking enormous risks, and was forced during July to liquidate because of all the margin requirements. And so that added an enormous amount of short-term selling pressure. It wasn't bled out gradually, it was dumped. So that caused a lot of it. Well, that source of selling pressure has now been removed, but it's interesting the market is not convinced because of the way that the semiconductor sector finished on Friday. There is also what I spoke about before, which is an emphatic diversity of opinions. So it's very hard to get this period right because the opinions are they're all over the place, but they're also at incredible extremes. So overall, this is not a market that is responding to reasonable price signals. You've got to be a lot more perceptive than that, because if you just take the market reaction on face value, it might turn out to be a 24-hour wonder. Now, looking at MU, Micron, along with SK Hynix and Samsung, were the stocks that have really amplified the volatility. Just the point on how it finished on Friday. Friday looked really good. We had a massive sell-off, which I understand was part of the finality of all of this memory stock leverage unwinding. And then we had a positive announcement about the state of play there, and we got a huge rebound on Thursday, which is, I think, 18% up. And then on Friday, we gapped up, so things looked great on the open, but look at the close. We ended up down 6%. So that's not great, and that's pretty much across the semiconductor sector. Now, again, just stepping back and looking at the last little bit, there were any number of people who at this point here on the 17th of July were telling you that this was a buy the dip opportunity, screaming buy. And yet we now find ourselves from this point, we now hit a low, which was 25% below the peak here. Up 18%, down 6%. This kind of volatility is really just a casino. And if you look at the chart now with just a little bit more evidence, you can see very clearly we've got lower highs, lower lows, and we're in a downtrend channel. So we've gone from the 17th of July to a screaming buy the dip to a confirmed and robust downward channel. If you are flying by the seat of your pants, running on headlines, running on social media, you have a very good chance of getting your head handed to you on a plate. Because the people that bought in here, was it possible that this was a screaming buy? Yes, it was. The valuations of some of these stocks look incredibly appealing. And that's why so many people crowded in and adopted margin debt to do it, because the logic was just so compelling. But as I've been at pains to make the point for years, you cannot rely on logic, and you certainly can't invest your money on logic into a crowded trade with leverage. It's just nuts. So this is where we sit at the moment, and no matter what you think, and the fundamentals around Micron, for one, are even more compelling. It's extraordinary, but look at the market action. You cannot deny the market action. So that's where we sit. But the long-term value, it's extreme, and it's better than it was a week ago. So what do we do with that? Well, you do nothing at this point in time. You don't have to be in the market. What's wrong with having some cash? Because ultimately, if Micron does end up being the extraordinary beneficiary that a lot of people think it is, then there's an extraordinary entry opportunity coming. What's wrong with sitting in cash while you wait? You don't have to participate. You don't have to try and guess the bottoms. Moving on to some other charts now. This is consumer discretionary versus staples. That's where we were last week. Down here, looked dreadful. 1 week later, it's incredibly positive. It's just so difficult to work all this out. And there's semiconductors, just to show you that it was an industry group-wide situation. Moving on to relative comparisons between sectors. The leadership, healthcare, finance, industrials, and energy. And this blue line here, this is XLK, so this is technology. Now, whilst technology is still sitting third in the totem pole, and it had a really big rebound on Thursday, look at the direction. Look at the highs and lows. This is still heading down very sharply, and a lot of other sectors are heading up. So the rotation continues. Turning now to the S&P on a daily chart, that was a lot of volatility on Friday, as you can see. We gapped up after a strong day Thursday. We gapped up, we traded down, and then we traded back up again. The market was really trying to come to terms with that. And there is the Russell on a weekly chart, so nothing much doing there. Going to the currencies, that's the US dollar. Daily chart, huge volatility for a currency. And the Australian dollar, as a consequence of that, finished just around the 70 mark. So moving on then to Aussie Stocks, 70.15 is where we finished. Our index picked up 2.3% and has got a pretty positive lead. Yes, semiconductors were negative, but many other parts of the US market were positive. So I would expect that our index could possibly move up. But again, it just depends so much on the performance of a couple of big stocks. As for the smaller end of the Australian market, there's just so many stocks that are just getting caught up in the severe wash that's coming through from America, from Asia, that has been caused by these crowded leveraged trades. I mean, who knows what we'll end up with, but there's certainly some very compelling stories in Australia. It's just the price action is very hard to follow. So I think as we enter earnings season for Australia, you can expect many, many big moves, both directions. But I think looking through all of what's preceded this in the last few months, the market has been starved of results and updates. So I think that most stocks are more likely to have a bias to the downside because the market is totally intolerant of anything that's not 100% perfect. So expect a very volatile earnings season through August and September in the Australian market. But the good news there is that these sort of market conditions, if you do your homework, they really do set up quite amazing opportunities. Turning now to precious metals, gold was down 0.2% for the week, and we're still hanging around this 4,000 key support. Silver didn't do anything. But look, when you look at the chart, you've got to conclude that the overwhelming odds are that we're going to get an explosive move in gold one way or the other. Now, that might sound like having a hedge each way, but it would be incredibly unusual if something like gold continues to do what it's doing, just flatlining. Logically, the move is to the upside, but I wouldn't rule out a bit of a fake to the downside first. It just kind of feels like that kind of market. Draw in as many investors as you can, sucker them in, and then boom, up she goes. But that's just the little voice on my shoulder thinking out loud. If we look at gold stocks, the downward momentum is stalling, which is the first thing that you need to happen before gold stocks could turn around and confirm an upward move. So that's one tick in the box. But we're still lacking confirmation, so that hasn't happened yet. There's silver. So silver, you can see the size of the ranges, the candle ranges on a daily basis and on a weekly basis are really starting to crimp in. And gold is very much the same. So we've got a rapidly closing wedge. There is nothing to say that this can't just flatline, but the odds of that happening are getting less and less and less. Market behaviour says that this is going to resolve, and it's going to resolve pretty soon with a lot of force. So I think I can say with absolute confidence, there is a high probability this is going to break with force one way or the other. Logic says up, but there are so many short-term cross currents that just are only working on a day-to-day basis. And what do they all add up to? I really don't know. I prefer to sit and watch in markets like this. And if we move to what the actual stocks are doing, so this is GDX in Australia. We had a base formation, but we're lacking in confirmation. So that's pretty clear cut. This is GDXJ in America. There's the top holdings, and that's the same thing. It's lost its downward momentum. We're getting an increasing squeeze, and almost always that resolves with a breakout with force. It's like winding up a spring, and then you let go of the tension on the spring, and away it goes. So that's where we sit in the precious metals market at the moment. Other commodities, copper, $6.44, continuing to look pretty positive and up near its highs. Crude oil, 84.67. Look, the big picture, the really big picture, is higher for a reason that I'll show you in a minute. But in the short term, it's very difficult to trust that big picture move higher. It could do anything. There's the copper chart up near its highs from May. There's the crude oil chart. Now you can see that we've had a very steep incline here when the Straits of Hormuz were closed. And then when things looked better, when there was a bit of a possible peace deal, we came back very quickly. So we've now formed a higher low. We don't have a higher high yet. But if you step back and look at that, you've got to say, well, okay, that the direction is probably up longer term. But what does it do before it forms a higher high? So we need to close between 95 and 100 on West Texas Intermediate crude. So that's where we sit on that one. So the final message here, the most important thing, and why I've been doing these Sunday videos almost every Sunday for 18 years, is how should most investors play this? I'm always trying to provide a perspective that cuts through the noise of whatever it is that you're absorbing. So let's have a look at that. And sorry, folks, but it's back to my old stomping ground of clarity of purpose and process. And I can just hear everyone saying, oh, God, not that again. But it's just so important. And if you've been hopping from one recommendation service to another, then what does that tell you about the merit of recommendation service only type situations? It tells you that they cannot and do not possibly deliver the outcome that you want. They just cannot, because it doesn't take account of what you're looking to achieve. And because I've been in a mentoring situation for 2 decades and spoken with thousands of people, I've got a pretty good idea of the breadth of different things that people are looking for and the breadth of their tolerance to volatility. It's extreme. So how can one recommendation only service put out something that is consistently useful? The answer is they can't and don't. There is no silver bullet. For all those out there that wish there were, hope there were, because that's just how they want to do it. They want someone to give them the next silver bullet that'll make them 10 times their money. It doesn't exist, and it doesn't exist because of things like psychology. So what is it that achieves what the vast majority of investors are looking for? And it's very simple. It's not necessarily easy. There's no free lunch here, but it is very simple. They're looking for guidance and they're looking for support to manage risk and psychology, because they're the two things at the end of the day that you've got a heck of a lot of control over. There's lots of things going on in the market at the moment that are an absolute washing machine. And that's how you manage risk. You step back, you get some cash, you position yourself and you prepare. So that ultimately is how you deal with this kind of market. It's very simple. You manage risk and you manage your psychology. But most people have no idea how to do that. They have no idea of the tools at their disposal. And yet most things are within your control. And the other part that you need, but you don't need it up front, so don't race out and think getting an education is the answer, because that ain't the answer either, not as the main pillar. It's an as you go, as you learn on the job, market savvy education. So it's not accepting all the grisly old headlines and concepts that have been around for decades that just don't apply anymore. It's an education that is related to what markets are actually doing now. All of the fancy new derivatives, all of the new leverage options, unless you understand how that impacts prices, then you could be totally confused. Because logic does not translate to price action. We see it every single day. It doesn't. And just a pure market education will teach you what should logically happen. But the markets just don't work that way. They're looking ahead. The volatility is here to stay. You've got to get the theme right, but that is nowhere near enough because we're now in an environment where the rising tide does not lift all boats. So theme right first, but then you've got to get down to the highly specific stock selection. And we're seeing enormous divergence in reaction from the market. Stock can react 15% down or 15% up. Look at the difference between Microsoft and Amazon and Meta. It was the market reaction that was the huge diversity. And then, of course, the ultimate way of managing risk is with your weighting plan. And unless you understand how to allocate your money across sectors and across stocks and how to shift it as momentum goes up and goes down, then you're really guessing in the market. So what we do with guidance and support, it's not very sexy, but it does produce results. And we've had many members who've been with us for between 5 and 10 years and beyond. That says something, particularly in these kind of markets. And it's their success and our enjoyment of the process that gets us up in the morning. This is an incredible period in time, and there's just so much market excitement. It's hard to miss. It's like the greatest movie you've never seen. So that's it for this week. I'll be back with you next week. I'm sure there'll be an enormous amount of market moving activity next week. So I'll be back with you then. Cheers.